Welcome back to Market on Close. I'm Sam Vardas alongside Marley Caden in Chicago. The Fed is front and center this week ahead of its announcement tomorrow, where a 25 basis point cut is expected. But traders and investors will be listening very closely to commentary from Fed Chair Jerome Powell, and if he hints that more cuts are on the way. Marley Caden in Chicago has more.
Thanks so much, Sam. I'd like to welcome in Zed Francis, the co-founder and CIO of Convexitas, joining us in studio today. Zed, always a pleasure to have you. You know, last we spoke about this, you were here with me, I think back in May, and we were talking about that 3 seemed to potentially be the magic number of cuts that we were going to see. Do you still think that 3 is the number we're going to get when we get the projections tomorrow?
Yeah, no, I think that has been the easy button, if you will, for the last call it 6 months. And I think the data has come in to just keep them nicely on the path of starting tomorrow and just doing one a meeting and kind of setting the precedent that, hey, we're going to start this cutting cycle. We're not going to tell you exactly where we're going, but the dots are going to imply that the market's about correct.
And so let's take it back to Jackson Hole, because, previously, at least last year, that was our signal that potentially a wider cut was coming, and then it came. And, what were your takeaways, since we haven't spoken since Jackson Hole, of sort of any kind of tone change you noticed or any sort of underpinnings that were unexpected for you in any of the commentary now as we're in the September meeting?
Yeah, I mean, I think circling with half of my colleagues, some of them are like, oh, like that was about as expected, maybe like a couple of like hawkish things, maybe a couple of dovish things. But myself, I was stunned by that meeting. I thought that was Jerome waving the white flag saying, you know what, I'm not going to put up any resistance to the kind of path everybody's trying to go down. I'm already a marginal lame duck, person here. It's only going to get worse as time goes on. And ultimately, my gut is when they, had their dinner, they're all kind of hanging out and talking. You had 2 dissents the previous FOMC meeting. And I think that what the vibes he was getting from that dinner was there was going to be more dissents if he didn't kind of alter the path here. And so I think he was actually, for the first time in his, what are we coming up, like almost 6 years in the job, starting to go with his committee rather than kind of driving the committee, and the rest of the committee was saying it's time to get going.
And so with that said, I guess I have to ask the follow-up that do you feel in any way that Fed independence has been compromised, or is it just that the positioning within the market committee itself is changing?
I think the position within the market committee itself is the main driver. I think if he was only fighting, we'll call it one battle, that we would not have seen this reasonably significant change in tone. But as soon as it came from, inside his own house, that ultimately it's meant to be a committee. Yes, he's a leader, but ultimately it's meant to be a committee. And I think the committee was telling him, we think the data is shifted here and we're ready to get more towards neutral, which I think they were all in reasonable agreement they were above.
And so tomorrow, your expectation is 25 basis points, 50 basis points. What's the cut?
Yeah, I think there's no reason here to go against essentially what's being priced in the market. So my gut is 25, but then also have a reasonably strong indication via the dots and also his language to say, this is not a one-off. This is the start of a new cutting cycle. And it essentially is priced in the Fed Fund futures is what I would expect them to somewhat dictate, both with the language and the dots.
So let's talk about the dot and the summary of economic projections, because we'll get those as well. And, that'll give us more clues about what to expect here. We had the 2 dissenters before. Now we've got Stephen Myron in the room, and the potential that if the dynamics have changed in the committee that we could see more. How many are you expecting more dissents this time around? And also sort of what's your projection as we move into the rest of the cycle?
Yeah, I think ultimately the dissents were a little bit of, we'll call it raising their hand for maybe I should be considered for an open seat that is coming up in a little bit of time.
In May?
Exactly. But I think now that we're at this like impasse where most likely everybody's going to start this cutting cycle and what it's going to look like, my guess is they do it on a uniform front. There'll be a little bit of language and the dots basically saying like some people might have said they should have done 50 via their dots. But holistically, I don't think anybody's dissenting. This is a uniform. We're restarting this cutting cycle and here's somewhat of the game plan.
Okay, a different perspective than sometimes we've heard. Now, as far as the press conference, which I think more people are even looking for just to hear some of the tone that we're getting, are you expecting dovish tone, hawkish tone, or a complete neutral?
I think it's going to be a little bit dovish, but mostly I think he's just going to do the standard letter of the law. This is what we saw change. This is what we voted on. And I think ultimately he's going to continue to kind of step back, kind of say, this is no longer, my institution to plot forward. Because we all know the most valuable thing the FOMC actually has is forward guidance. And now we're kind of stepping out of the range where he's no longer going to be the person in charge, where forward guidance is effective. So I think he's going to just be boring, letter of the law, kind of set up the table to pass the torch, who's going to be nominated likely in the next month-ish, which is kind of standard cadence, somewhere in between Halloween and Christmas is the time. And amazingly, with all this chaos, it looks like we're going to probably land the plane exactly in historical normal time. But I think he's just going to start the transition process.
Okay, and so with all of that said, they have their dual mandate, and they've sort of pivoted to say we're focusing more on the labor picture than the inflation picture. And we've gotten quite a bit of data since that speech was made. As they focus on the labor picture and we start to get these cuts, is inflation going to become a greater concern? And then how do they deal with that?
Yeah, I'm, to be honest, pretty impressed by the rally that's taken place in longer end treasuries, because we essentially have, we'll call it tax cut extensions, but a little bit more government spending in the plan. The ultimate results of spending cuts have not really shown through. So we're still on the max spending and no kind of intent of reining that back. And now we're saying, high twos inflation, that's a-okay. We care more about a labor market. And obviously we have asset prices at all-time highs. We have second derivative risk, basically saying there is no risk. So everything is kind of saying guns a-blazing for growth and not really caring about wrangling in inflation. And yet we've had a kind of 40 basis point rally in 10 over the last 6 weeks, basically ever since that poor labor report from July at the beginning of August. So I'm a little surprised at this point in time that the long end has just said, we must be heading into something similar-ish to a recession. Thus, gut shot reaction is you buy duration, even though everything else says, in the out years, deficits are going to keep growing quite significantly.
So we had a guest on Trading 360 earlier who said to me that she felt there was much greater risk in bonds right now with the rate cut environment where it is than in equities. I'd love to get your thoughts on that.
Yeah, I think it's difficult to see a significant rally in the long end from here, sans a real significant problem in both the real economy and, frankly, markets at the end of the day. If they're already starting the cutting cycle, most likely tomorrow, the reaction function is not necessarily going to be there for the long end to rally significantly, even if equities were to have a problem, unless they go full bore QE. You start running out of where are these buyers going to come from for long end paper? Shorter day paper, sure, you can have things move around a bit, but I do find it difficult to come up with an interesting argument of why you should want to own duration.
And so last question here, you mentioned the market response tomorrow. What do you expect the market response to be, knowing that it's basically baked in now? I mean, it's priced in.
Yeah, it has been interesting thus far. What we've seen is any of these types of events where things have come in, we'll call it in line with expectations, have just been another opportunity for the market to continue to grind higher. It's like a roll-off of an event on the calendar gives it an all clear for things to continue to grind. I think a little bit of that is back to positioning, where ultimately retail investors have been pretty well risked and continue to accumulate more risk. And institutional investors have been, we'll call it behind the eight ball in terms of re-risking after a little bit of the chop to start the year. And so it's tough to see anything different where institutional investors are running into the final 3.5 months of when they kind of get clocked on performance. They've been light risk during the vast chunk of this rally. When you get something that is viewed probably by markets as a reasonable supportive thing towards risk, and there's no known event on the calendar coming up that's going to upset the apple cart, ultimately it seems like the grind higher is the most likely path.
Well, Zed, we appreciate you being with us. Thank you so much. That's Zed Francis, the co-founder and CIO of Convexitas.